Welcome to this tax compliance and planning class. My name is Hayley Farndon. I'm a senior tax tutor at ACA Masters, a chartered accountant and a chartered tax advisor. When I sat my chartered accountancy tax exams, I won a prize from the Institute. During this class, I will be working through a full income tax question so I can show you how to deal with the main areas of income tax. The class is taken from the ACA Masters Tax Compliance and Planning video class, and the materials I will be referring to throughout the class are the ACA Masters Tax Compliance and Planning materials. Further details of the video course and materials can be found on the Tax Compliance and Planning page of the ACA Masters website. When answering the exam questions, we always recommend looking at the requirement first so we know exactly what it is we have been asked to do. We can also look at the mark allocation so we know how much time to spend on each requirement by multiplying the marks by our minutes per mark we have available in the exam. So let's go down to the requirement to see what we've been asked to do in this question. So the requirements. We have 3 requirements here. Requirement A, calculate Harvey's employment income for the tax year ended 5th of April 26. Show your treatment of each item, and that's worth 8 marks. And then part B, calculate Harvey's trading income for the tax year ended 5th of April 26. Show your treatment of each item, and that's worth 10 marks. And then part C, calculate the total income tax payable by Harvey for the tax year ended 5th of April 26. Show your treatment of each item. So we can see we've got 3 parts to the question here, and we've been told to ignore VAT. The question in total is worth 25 marks. So this is the highest amount of marks available for a tax compliance and planning question in the exam. We've got 8 marks for calculating the employment income, 10 marks for looking at the trading income, and then 7 marks for bringing it all together, calculating the income tax payable and factoring in any other income that Harvey has. So if we go up to the top, we know firstly we need to look at employment income and then trading income, and then we're looking at total income tax payable. We can see we've got some background information about Harvey, then we've got information on his employment with HEL, and then moving down we've got another section on other income and expenditure. So this will likely include all the information about his trading income and then his other income that we'll need to factor into part C of the question. So for part A of the question, you can see clearly set out we've got the employment with HEL section. So this is the section we'll need for the first part of the question. We're now ready to read the full question and background information. We can now read through this in a very active way as we know the requirements, which are to prepare the calculation of the employment income, the trading income, and then calculate the income tax payable. So we know Harvey will have employment income, trading income, and also some other types of income. So we have already started to think about how we will pull together the answer. So we know in our answer, we're going to need calculation for employment income, we're going to need a calculation for trading income, and then we're going to need a section here for the income tax computation to bring all the income together. So we're going to have our employment income, we're going to have trading income, and then we can include other types of income once we know what other income Harvey has. And in the exam, there is a pro forma you can use for the income tax computation. So this then sets out the different types of income, and you've got the non-savings income, the savings income, and then the dividend income. And we know we sum up all the different types of income to come down to our net income, and then there'll be the personal allowance we need to consider, and then we'll have the net income after the personal allowance, and we then start taxing through the bands. Already, before we've even read the question, we know what we're going to be doing. We're going to be calculating employment income, trading income, and then the income tax computation, bringing it all together with any other income. And for each section, we're likely to need some workings, so we can clearly set out any workings for employment income and for trading income. So we can now start reading the background information and highlighting any information that is key for the questions that we've been given for this exam question. So Harvey is 52 years old and is UK resident. So we've been told here that Harvey is UK resident, which we know means that he will be taxable on his worldwide income in the UK. He has worked 2 days per week for Home Entertainment Limited since 2020. This is his employment. He's employed by Home Entertainment Limited. Harvey also runs a hair salon as a sole trader. So this is his trading income business where he's working to run a hair salon as a sole trader, and owns a residential property near London Hilling Road, which he has rented to tenants as a furnished let since 2021. So we know now in our answer that in addition to employment income and trading income, we're also going to have property income. Harvey records all of his income and expenditure, other than that related to his employment with HEL, in a cloud-based accounting software package. Harvey has elected to use the accruals basis for his trading income, and he does not claim fixed rate expenses. So we know for individuals with trading income, the cash basis is the default method of calculating trading income. But we've been told here that Harvey has elected to use the accruals basis. So we'll be looking at the accruals basis when calculating the trading income. We then move on to the employment section with HEL. And this is a typical employment tax question where we've been given details of Harvey's remuneration package. And for each piece of information, we need to read it through and think about how this feeds into our answer. It's a salary of £30,000 per annum. However, under the company's optional remuneration arrangement, Harvey has reduced his salary by £300 to £29,700 to be provided with a private gym membership by HEL. The gym membership costs HEL £360 per annum, and the normal membership price is £420 per annum. So here we know that Harvey is receiving a cash salary of £29,700. And we know that this will be taxable for Harvey as cash received. And we know the best thing to do for employment income is separate it between cash and benefits, and also any allowable deductions, as then when we come to the end of the question, when we're calculating the income tax and national insurance, we've clearly split it out between cash and benefits, which makes it easier at this stage. So the first thing we're going to feed into our employment income calculation is the salary of £29,700. So this is an easy first mark, and normally where we have employment income, there'll always be a salary element, so that will sit under cash. We'll then have a section for benefits and then any allowable deductions. In this part of the question, we've also been told that Harvey is provided with a private gym membership by HEL, and we know that this would be a taxable benefit for Harvey. We're told a number of different points here. So we're told that Harvey has reduced his salary by £300. The gym membership costs HEL £360 per annum, and the normal membership price is £420. So the question here is, which amount is the benefit for Harvey? In the employment income class, we looked at how the benefits apply here, and where it doesn't fall into any of these categories here, which this one doesn't, this will be other. So where there's another benefit, the taxable amount is the cost to the employer. We also need to consider the salary sacrifice element here, as we were told that Harvey sacrificed salary for the gym membership. So where there is a salary sacrifice, the benefit that will be taxable would be the higher of the benefit amount. So here the cost to the employer that we just looked at, or the cash sacrificed. We were told that Harvey sacrificed £300 and the cost to HEL was £360. So the higher of these two will be the £360. So in our answer, we will have the gym benefit here of £360. So we've now dealt with the first part of the question, and you can see that there's some information provided in the questions that you don't need. So here we're given the normal membership price, but that's not relevant for the question. So for the exam, it's making sure you can pick out the relevant information. Next section, a car with a list price of £36,500, which cost HEL £33,900. Harvey contributed £6,700 towards the capital cost of the car. Harvey pays for all diesel costs. The relevant benefit percentage based on the CO2 emissions is 32%. So instead of being told the CO2 emissions here, we've been told the percentage to use. If you were given the CO2 emissions, then you would look the percentage amount up in the tax tables. So we're told that Harvey has been given a car with a list price of £36,500, and this cost HEL £33,900. We know for car benefits that this is always based on the list price. So Harvey's going to have a benefit of the list price times the CO base percentage, which we've been told. So for the car, we'll have a sub-working. We've got the list price, which we're told in the question is £36,500. We were also told that Harvey makes a contribution here. So where an employee makes a contribution, this reduces the benefit, but from the employment class, we know that the capital contribution is capped at £5,000 here. So even though Harvey paid £6,700, the benefit can only be reduced by £5,000 here. So we can reduce the list price by the employee contribution. So that reduces the amount to which we apply the percentage to be 31,500. We then need to multiply this by 32%. So if we do 31,500 times 32%, we have a benefit of £10,080. So we know we're going to have a car benefit to bring in here of £10,080. We were also told in the question that Harvey pays for all diesel costs. So we know we're not going to need to calculate a fuel benefit here. If we were told that the company paid for the fuel cost, then we'd also need to calculate the fuel benefit. So we can now move on to the next section. A general lump sum allowance of £250. Harvey spent £190 entertaining HEL clients. So when we looked at our class, we said if an individual is given a specific entertaining allowance, then the only amount that would be taxable would be the entertaining allowance minus any amount spent on entertaining. But we're not told that in our question. We're told that Harvey was given a lump sum amount of £250, which means that he will be taxable on the full amount of the cash received. If it had been structured as an entertaining allowance, then he would only be taxed on the excess, which would be the £250 minus the £190. So here, the £250 will be taxable as this was a general lump sum given to Harvey, and that will be taxable as cash. So we have the lump sum to bring in here of £250, and then we can move on to the next piece of information. Use of video gaming equipment owned by HEL from 5th of November 25. We know that we're looking at the tax year to 5th of April 26, so this benefit is only available for part of the year, so we're going to need to prorate it here. It's only available from 5th of November until 5th of April, so that would be 1 month to 5th of December, then to January, then to February, then to March, then to April. So that will be 5 months of the year. So 5/12 of the annual amount will be taxable. The equipment cost HEL £620 and had a market value of £840. So if we go back to the ACA Master's Notes, we know that where there is use of an asset, the amount that is taxable is 20% of the market value of the asset or the rent if higher. So here we've been told the market value is £840. So the taxable benefit is going to be 20% of £840. So we will have a working for the asset. The market value, we're told, is £840. The benefit is going to be 20% of this, so 840 times 20% gives a benefit taxable for Harvey of £168. And important to remember here that Harvey only had the asset for 5 months of the year, so we're going to need to take the value of the benefit and multiply it by 5 and divide by 12. And that gives us a benefit for 5 months of £70. So then we would bring in the asset benefit up here, which is £70. And really important to remember, if you do have any amounts to pro rata in terms of months that you're given this information in the question, making sure you do apply the benefit only for the months that the employee had the benefit. We can then move on to the next point. HEL and Harvey each make pension contributions to the HEL workplace pension at an amount equal to 2% of Harvey's salary. So we can calculate the pension that both Harvey and his employer will be paying into his pension. We're told this is 2% of his salary. So his salary was £29,700. We're then going to apply a 2% rate to this. So Harvey and the employer HEL will both be making a pension contribution of £594. We know from the employment class that where an employer makes a pension contribution to either an occupational or a personal scheme, then this is an exempt benefit for the employee. So the employer pension contribution will be an exempt benefit for Harvey. And then in terms of his individual contribution, this is a pension contribution to a workplace scheme. So this is one of the few allowable deductions against employment income. So Harvey can deduct his contribution to the employer pension scheme here. So firstly, for the employer pension contribution, we know that this is an exempt benefit, but we should include it in our answer to show that we've thought about each item and we were told to show our treatment of each item. And then we'll have the employee pension contribution down here. We'll have a deduction of £594 that Harvey can deduct from his employment income. And then the final point, we're told that HEL deducted income tax of 5459 via pay as you earn. We know when we looked at the income tax computation that once you come down to the tax liability, you can then deduct any tax already paid. So this is tax already withheld by the employer through pay as you earn. So we will deduct this from Harvey's income tax liability once we've calculated it. So no impact on the employment income, but over here we need to make sure that we deduct the tax already paid from Harvey's tax liability once we've calculated it. So we'll need to deduct 5459 from the income tax liability. If we move on down, this then takes us on to the next section, which is other income and expenditure. So this is all the information here for Harvey's employment income, which means that we can sum up Harvey's employment income. So if we total all the amounts we have for cash benefits and then the allowable deductions, that gives us employment income for Harvey of 39,866. So this is part A of the question now completed together with the workings below here. And when we're looking at the income tax computation, we can then refer this back to working 1, which is our employment income calculation. This part of the question was worth 8 marks, so you can see plenty of easy and medium marks here to do really well in this question. There's a number of different backing calculations and then marks for showing all of the elements of the employment income and the allowable deductions. So we can now move on to start calculating our trading income, which will be working 2, and we can then refer that back to working 2 in our income tax computation. So other income and expenditure. Harvey has provided the following information, including figures downloaded from the cloud-based accounting software package. Income and expenditure for the year ended 5th of April 26, which is the year we're looking at, with giving details of income and expenditure coming down to the net income of 52,964. And then we've got some notes regarding various pieces of income and expenditure. So we can see in here, we've got firstly income sales in the hair salon, and then we've got interest from the business bank account, interest from Hilling Road, rent from tenants. So we've got a number of different income amounts here. This doesn't all relate to the trading income. So we're going to need to strip out which amounts relate to the trading income and which amounts relate to other income. And the same with the expenditure. We've got salaries paid to the salon manager, but then we've got some Hilling Road costs relating to the rental property. So we're going to need to split out which expenses relate to trading and which expenses relate to non-trading. We know from the trading income class that we can start with the profit before tax, which is the net income, and then make adjustments to come down to our trading profit or loss, or we can look at this on an income in and expenses out basis. So we could say what is actually taxable for the trade, which would be the sales in the hair salon, then take off any deductible expenses. So in the exam, you can choose which way you do this if you're given the information to be able to calculate this in both ways. And for this class, I'm going to calculate it for both methods to demonstrate how to do this. But obviously in the exam, you would only choose one method. We'll set up the calculations for each method and then work through each piece of information, and then when we've got a note, refer down to the information and see how this impacts our answer. So we're now going to be focusing on the trading income. For the first method to calculate trading income, we're going to start with the net income, which we were told in the question is 52,964, and for the second method we're going to look at taxable trading income and then deduct any trading expenses. And by doing these two methods, we should come down to the same trading income for both. So let's go through each piece of information and see how we would treat this. So firstly, sales from the hair salon, 97,360. So if we're working on the method where we start with the net income, we know that the sales are already included with the net income, so there'll be no adjustments to make here. But if we're looking at the taxable income and expenses, then we need to bring in this taxable income here of 97,360, which is sales from the salon. And then the next information we're given is interest from business bank account, £214. So for individuals, we know that interest income is taxed separately in the income tax computation under savings income. So this does not get taxed under the trading income schedule. So when we're starting with net income, we're going to need to deduct out the interest, as this should not be included in trading income. So we would take out £214. And when we're looking at the trading income on this basis, where we're looking at taxable trading income and expenses, then there's no adjustments here as this interest does not relate to trading. We also know that this interest will be taxable separately under interest income, so we can make sure we feed that into our income tax computation for the later part of the question. We've got £214, which is savings income. So where we're given information regarding other types of income, we need to strip it out of trading income, but remember it needs to be taxed elsewhere in the income tax computation. The next piece of information, income, Hilling Road, rent from tenants, £18,200 with note 1. Monthly rent of £1,400 is due on the 1st of each month. The tenants paid the rent due on 1st of April 25, on 10th of April 25. All subsequent rent payments were made on time. And we know for property income that the cash basis is the default method for income less than £150,000. So this will be the default method here. We'll be looking at the property income on a cash basis. So we've been told that tenants' rent is due on the 1st of each month. So we'll have 12 months of £1,400, but then we know the one from 1st of April 25 was paid late on 10th of April 25. So that one will also be taxable in 25-26. So we're going to have 13 months of taxable income for the Hilling Road property. So the way we need to reflect this in our trading income is that for the method where we start with net income, we're going to need to deduct the rent that was included, which was £18,200, and then we're going to need to bring in the taxable amount under property income. So we can have a sub-working down here for property income, and we know that the income taxable here is going to be 13 months of £1,400 a month. So we would tax 13 times 1,400, which would be 18,200. So this is the same as the amount that was recorded. And if we were looking at our trading income by looking at receipts and expenses, we know there'll be nothing to include here as this all relates to rental income. So back to the question. And the next one, dividends received from shares held in an ISA, 1,270. We know that for shares held in an ISA, the dividends are exempt, so there is no tax on the ISA dividends here. So we need to take out the dividend income where we're looking at the adjusted net income, because we don't want to tax this in our trading income. So we need to take out 1,270, and there's no adjustment required for trading income. And then over here, we know we've now got another source of income, which is dividend income. But for the dividend income, we're going to bring in a zero amount, and we can just say here exempt because it's in an ISA. So we're taking out 1,270 from the trading income, and then normally we would then bring that into tax in the income tax computation, but we know that the dividend income is exempt as the shares are held in an ISA, so nothing to bring in here. So then the next piece of information, expenditure, salary paid to the salon manager, 19,800. So that will have already been deducted in arriving at the 52,964. So there's nothing there to deduct if we're starting with net income. But if we're looking at trading income, looking at income and expenses, then we've got the salary for the salon manager to deduct. And that amount was 19,800. The next one, national insurance, note 2, 4450. So Harvey paid the following national insurance contributions during the year. Class 1 secondary, £1,020. That will be the employer's national insurance in respect of employees, so it could be the salon manager. And then Class 1A national insurance, so that's in respect of benefits paid to the employees, £130. And then Class 4 national insurance, £3,300. We know that Class 4 national insurance relates to Harvey's own national insurance in respect of his trading income, and this is not a deductible expense for trading income. So this is a personal expense of the owner of the business, so the Class 4 national insurance contribution. So the Class 1 and 1A national insurance can be deducted from trading profit, but the Class 4 cannot be. So if we're starting with trading income, we know that we're going to need to add back the Class 4 contribution here of 3,300. And if we're looking at income and expenses, then we know we can deduct the national insurance Class 1 and the national insurance Class 1A. So the national insurance class 1 was £1,020 and the national insurance class 1A was £130. So they are both deductions from the sales income. As these relate to trading expenses, they are the national insurance liabilities for employees. And then the next one, utility bills, gas, electric and water, 6,800. So these are just normal expenses that are deductible from a trading business. They all relate to the trade. And then hair products, similarly, 1614, again, they're normal deductible expenses. So if we're starting with the net income, there's no adjustments required here for the utilities or the salon products. But if we're looking at income and expenses, then we can take a deduction for the utilities of 6,800 and then the hair products of 1614. So here just showing how the different methods work. If you've got an expense included in net income, which is tax deductible, there's no adjustment to make as it's already included. And if we're looking at trading income and deductible expenses, we need to include any deductible expenses. The next one, supply entertainment, £860. We know that third-party entertaining is not a deductible expense for calculating trading income. So it's already been included in coming down to net income. So we need to add this back here. So we've got entertaining. We're going to need to add back £860. And if we're looking at the income and the deductible expenses, then there's nothing to deduct here as it's not a deductible expense. So no further adjustment there. And then the next one, legal fees with note 3, 12150. Legal advice on new health and safety regulations. This is a deductible expense. We know that legal fees are only not tax deductible if they are capital related, but these are not capital related. They're related to general health and safety advice. There's no adjustment required here as it's already been deducted, but if we're looking at income and expenditure, then we can deduct the health and safety legal fees, which are 1,250. And then the next one, we have a van with note 4, 14,800. Harvey purchased the van in January 26 so that the salon manager could collect large volumes of products from the supplier. The van has CO2 emissions of 86. During the 3 months to 5th of April 26, a total of 180 miles were travelled in the van. Harvey used the van for private purposes for 3 days in February when his car was being repaired, travelling a total of 18 miles. The salon manager travelled 70 miles in the van for private purposes. All other use was for business purposes. So there's a few different points here we need to think about in respect to the van. Firstly, Harvey purchased the van, so this has been deducted here in coming down to our net income. But we know that Harvey has elected into the accruals basis, so he will need to claim capital allowances on the van rather than deducting the amount. So the first adjustment we need to add back the cost of the van here, where we're looking at the trading income, as this has been included in the net income here, and we need to add that back as we know it's a capital cost, and then we will need to work out capital allowances on the van. So in terms of our capital allowances, we're not told about any brought forward amounts, but we've got the van that was purchased in the year of 14,800, and we were told there's some private use element here, so we need to put this in its own private use pool. When we're looking at private use, we're only looking at the private use for the business owner, which is Harvey. We don't need to worry about any private use for the salon manager, but we do need to adjust for the private use for Harvey. So 180 miles were travelled in the van and Harvey used it for 18 miles private use. So that's a 10% private use here. So capital allowances can only be claimed on 90% here. So only 90% capital allowances can be claimed here. In terms of the capital allowances that are available, we know that it's a van that will go into the main pool. We don't need the CO2 emissions. We're looking at a van. We're not looking at a car. And in terms of the van, this would also qualify for the AIA, and we know that that's 100% allowance up to £1 million. So we can claim 100% allowance here for the van, subject to the 90% restriction. So we're going to have the allowances available at 90%. So the AIA would be available of the total amount, but then the actual allowances available would be the 14,800 times 90%. So capital allowances available would be 13,320. If we're looking at the income and expenses, then we know we need to deduct the capital allowances as an expense. So the same amount would be deductible here, which is 13,320. And we can then move on to the next piece of information. So transfer into personal pension, £4,000. So this is appropriation of profit for Harvey. We know that any appropriation of profit is not tax deductible for trading income. As this is withdrawal of profit from the business, it doesn't matter what Harvey has then gone on to do with it. The pension contribution will be treated separately, but we know we're going to need to add this back here. £4,000, as this was deducted in arriving at the net income. So we add back the £4,000. We know that Harvey transferred the amount into a personal pension scheme. And when we looked at the pension class, we know that the way individuals get tax relief for pension contributions is that they receive tax relief at the basic rate when the amount goes into the pension scheme. So although Harvey has contributed £4,000, this will be grossed up for the basic rate tax for the amount that goes into the scheme. And then if he's a higher rate payer or an additional rate payer, we need to increase the band for the amount of the gross personal pension contribution. So let's do a sub-working for that, which we know will be important when we come to our income tax computation. So for the pension, we were told that the net contribution was £4,000. We can then gross this up for the basic rate tax. So we can either times by 100 and divide by 80, or we can multiply by 1.25. So let's multiply by 1.25. So that gives a gross pension contribution of £5,000. And then when we come on to calculate Harvey's income, if he is paying tax in the higher rate band, we will then gross up the basic rate band. So let's make a note here that we may need to gross up the basic rate band and possibly the higher rate band. So we would start with the normal basic rate band, which is 37,700, and then we would make an adjustment for the gross pension contribution of £5,000. So if Harvey is a higher rate payer, then his revised basic rate band will now be 42,700. So that deals with the pension, and we can look at how that impacts the income tax when we come on to the third part of the question. So back to the question, the next piece of information, Hilling Road estate agent fee, 10% of the rent. This is a fee of £1,820. So when we're calculating property income, we know that expenses relevant to the property can be deducted. So if we take off the estate agent's fee, which is 1,820, so this calculation here is then going to calculate our property income that pulls into the income tax computation. And then Hilling Road replacement fridge with a note 5, £686. The fridge is the same model as the one it replaced. So where we have a replacement of an item and there's no upgrade on it, so it's replaced on a like-for-like basis, then this is a deductible amount. So as the fridge is the same model as the one it replaced, then £686 will be deductible here. If it had been an improvement, then we would have to look at the amount that will be disallowed here. So we can deduct £686 for the replacement fridge. And then Hilling Road mortgage payment, £8,000 with note 6. The mortgage is an interest-only mortgage. When we looked at the property class, we said that interest payable on a mortgage is not tax deductible from the property income itself, but it can be deducted down here as a tax reducer. So finance costs payable on a residential property, and this is capped at 20% of the interest. So we would look at 20% of the 8,000. Or if the property income is lower than the 8,000, or the taxable income is lower than the 8,000, then it will be capped at these amounts. So we will work out 20% of the interest income and then to deduct this once we have calculated the tax. So this is a tax reducer rather than being a deductible amount against the property. It's a bit of a tricky point here, but we will not be able to take any deduction here from the property income, but we need to remember over here that we will have the tax reducer. And the tax reducer is going to be a maximum of £8,000 at 20%. So the maximum we can deduct here, assuming we have sufficient tax to deduct this amount, is £1,600. So we'll be able to deduct £1,600 if we have tax to pay of more than that amount. And in terms of the rental expenses, the impact on the trading income, we know that they were included in the net income, so we're going to need to add back the estate agent's costs of 1,820 and the fridge of 686, and also the mortgage interest, which will be a tax reducer for the income tax. So whenever we have an adjustment to another schedule of income, we need to think about the impact on the trading income, and where it's been included in net income, we need to adjust for it. Whereas where we're looking at income that is taxable as trading income and expenses are deductible, then we just won't include them as they haven't been included anywhere in the first place. So if we go back to the question, we've now looked at all aspects of the income and expenditure, and we've looked at the notes associated with these income and expenditure, and we have one final note we haven't taken into account yet. So Harvey has an unused trading loss brought forward of £2,000 from the previous tax year. So if we go to our notes and think back to the losses class, we said that where we have a trading loss for a year, this can be carried forward against trading income, and this is automatic. So there's no claim required for this. This automatically happens. So in our case, Harvey's brought forward trading loss will automatically be offset against his current year trading income. So we can deduct £2,000 here, and this will be deducted in both cases. It doesn't matter how the trading income is calculated. And we should now be ready to calculate our total trading income for Harvey for 25-26 with the loss offset. So if we sum up all of these amounts, this gives us trading income of 51,426. And then using our other method, where we looked at taxable income and deductible expenses, this also gives us 51,426 as we would expect. And as we said at the beginning of the class, you would only use one of these methods in the exam. I've just talked through both here so you can see how both methods would work. And we've now calculated our trading income, and this will feed into the income tax computation over here. So we would have 51,426 taxable as non-savings income in the trading income, and we've already calculated the employment income for working one, which we know is 39,866. So we've now looked at all the information for the trading income. So this was part B of the question, and this was worth 10 marks. So you can see here plenty of easy and medium marks available to achieve the full 10 marks for this question, just clearly setting out the treatment of each item and making sure where you've stripped some income or expenditure out that is taxable elsewhere, that it's both stripped out and then taxed in another schedule. So we've now completed the trading income working, and we've also got the notes supporting these workings in terms of the capital allowances. We're now ready to move on to part C of the question, which is bringing together all of the information we've looked at so far and calculating the income tax payable for Harvey for the year. We were asked to calculate the total income tax payable, so we're not looking at national insurance here. It's really important with the tax compliance and planning exam questions to make sure you read the questions carefully and only do the calculations that are required, and make sure you do all the calculations that are required. So just really focusing on what the question has asked you. So we're just looking for the total income tax payable here. And if we had been asked for the national insurance, then we've already split up the employment income between cash and benefits, so this makes it easier to calculate the national insurance. So let's now focus on the income tax computation. As we said in the exam, you can use the pro forma calculation to help with this calculation. So we've got the employment income with the working, the trading income with the working. We now need to bring in the property income. So we did a working for property income over here. We had the income that was taxable in the year on a cash basis, the estate agent's fees, and then the fridge. So if we sum all these amounts up, that gives us property income of 15,694, and we can call that working 3. So we will bring in the property income over here of 15,694, We've already looked at the interest income, which we know is taxable as savings income, and then the dividend, which is exempt as the shares are held in an ISA. If we go back to our pro forma income tax computation, we then know that we add all of these amounts up to come down to our net income. We can then deduct our personal allowance to come down to the taxable income and then start taxing through the bands. So we'll now calculate the net income by summing these amounts up. So we've got net income of 106,986 for non-savings income and £214 for savings income. We then need to think about our personal allowance. We know that the personal allowance is normally 12,570, but that we need to adjust the personal allowance if the net income is over £100,000. And this £100,000 is after deducting gross personal pension contributions, which we know that Harvey did have a personal pension contribution. So what we can do now, we can calculate the adjustment needed for the personal allowance. Let's do our personal allowance calculation down here. So we need to start with our net income, which we know is the 106,986, add the 214 savings income, so that's 107,200. We can then deduct the gross personal pension contributions, which we calculated over here to be £5,000. So that gives us net income after the pension contributions of 102,200. We know we need the excess over the £100,000, so this gives us an excess of 2,200. And in respect of the personal allowance, for every £2 that the adjusted net income is above £100,000, then the personal allowance is reduced by £1. So we need to take 50% of this. So if we take 50% of the 2,200, that means we need to adjust the personal allowance by 1,100. The standard personal allowance is 12,570. We can then make the adjustment for the 1,100. So this gives us a revised personal allowance of £11,470. So this is the amount that Harvey has tax-free. So we can deduct here 11,470, and we know that we work left to right when allocating the personal allowance, and we can then calculate our taxable income after Harvey's personal allowance. So that then gives us our taxable income, and we're now ready to start taxing through the bands. When we looked at the pension contribution, we said that we need to extend the bands if Harvey is a higher rate payer. We can see that Harvey will be a higher rate payer as his taxable income is around £96,000. So we only need to adjust the basic rate band. So our revised basic rate band will be 42,700. So giving Harvey more income that is taxed in the basic rate band due to him making a personal pension contribution. So the first band that we're going to tax is the basic rate band, which we know is 20%, and that band is going to be 42,700 that we just calculated. So 42,700 of Harvey's non-savings income will be taxed at 20%, and then the rest of it, so the 95,516 minus the 42,700, will be taxed in the higher rate band at 40%. So if we multiply these amounts through, that then has calculated Harvey's income tax on his non-savings income. We can now think about the savings income. So Harvey has savings income of £214. When we looked at the income tax liability in the class, we said that there's a personal savings allowance where amounts are taxed at 0%, and this is £1,000 for basic rate payers and £500 for higher rate payers, and then nothing for additional rate payers. We can see that Harvey is a higher rate payer, so he is entitled to £500 of interest tax-free. There will be no tax in respect of the savings income due to the personal savings allowance of £500. So we've now calculated the income tax. We know that income tax will only be payable on the non-savings income. So we've got an income tax liability of £29,666, and we'd already factored in earlier that we've got the tax reducer on the mortgage of £1,600, and we can see we have capacity to deduct that, so that will not be restricted any further. And then we've got the tax already paid under pay as you earn. So if we deduct these two amounts, that will then give the tax payable now for Harvey, which is £22,607. So that gives our answer to part C of the question. And again, it's really important to be clear on what you've been asked. So we were asked for the total income tax payable by Harvey. So that will be after the deduction of the pay as you earn already deducted, whereas if we were asked for the income tax liability, that will be before this. So it's really important to be clear on what the question has asked you here. And you can see, again, plenty of easy and medium marks to pick up for the income tax. The key to becoming confident with the income tax computation is practicing as many questions as you can and getting really familiar with calculating the personal allowance, grossing up the bands if needed, calculating the tax, and then deducting any amounts that can be deducted. So that brings us to the end of working through the Harvey question. Quite an involved question, as a number of different types of income and some tricky areas in terms of the pension contributions and personal allowance. But plenty of medium and easy marks are available to pick up in the question, and that's what you need to focus on, picking up the easy and medium marks and then some of the harder marks if you can. And if you take this approach, then you will do really well in the tax compliance and planning exam. So in the exam, you would now copy and paste all your workings over to the word processing area. We've looked at many aspects of income tax in this question: employment income, trading income, property income, pension contributions and the tapering of the personal allowance, the mortgage tax reducer and extending the bands. We haven't looked at international tax in this class, but you can of course watch the international aspects class, which covers all of the international topics. If there are any areas where you are unclear, then I would recommend going back to the relevant class and then practicing as many questions as you can. And of course, there are other questions in the question bank where you can practice a full income tax question and test yourself on the knowledge you have for each area.